It's time for Yahoo Finance's Market Minute. Stocks mixed, paring back earlier losses after ISM manufacturing data falling into contraction territory in March, indicating stagflation. Meantime, shares of EV maker Lucid Motors jumping after the company confirmed it's capturing Tesla buyers at a higher rate. Lucid CEO telling Yahoo Finance, quote, "We see a clear uptick of interest in Lucid from Tesla buyers because they're looking for another option." Johnson & Johnson shares falling after a bankruptcy judge rejected its $9 billion plan to settle lawsuits for its baby powder that contains talc. This is the third time J&J attempted to settle using an element of the bankruptcy system. Shares of the owner of Calvin Klein and Tommy Hilfiger, PVH, are surging as its full-year sales outlook tops analyst expectations. Still, PVH's CEO warning of a tough consumer backdrop in North America and China. That's your Yahoo Finance Market Minute. Scan the QR code for more.
Welcome to Wealth. I'm Julie Hyman in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, Portfolio Checkup, we dive into the performance of financials a little over a week out from the sector's kickoff to the second quarter earnings season. And homebuyer trends, we discuss the latest report from the National Association of Realtors that finds baby boomers are once again the largest share of buyers. What's keeping young people out of the market? We'll discuss. Plus, all week on Wealth, we're talking about student loans ahead of the 25-26 school year. We'll dig into all things FAFSA, loan advice for current and incoming students, and break down how to make your first student loan payment. But first, let's take a look at some of the market action. 90 minutes into the trading day, we see a mixed picture now as Wall Street braces for the rollout of tariffs tomorrow from President Trump. We also, by the way, saw the latest manufacturing data coming in lighter than had been estimated. Still, though, we are seeing that mixed picture. The S&P 500 trading higher at the moment, just by about 0.1% here. But we're seeing pressure elsewhere in the markets as people try to position given that economic data and also the anticipation of tariffs. Well, we're kicking off the second quarter today. Financials wrapping up Q1 up 3%, outpacing all three major averages. But if you drill down into regional banks, they underperformed, with the regional bank ETF KRE closing the quarter down more than 5%. Here to dig into the latest action around financials is Anton Schutz, Senior Portfolio Manager at Mendon Capital. Anton, it's good to see you. So interesting action in the first quarter from the financials. As I said, broadly, the financials did pretty well, but those regionals did not. Why the negative sentiment there in particular?
I think there's a lot of reasons for it. Certainly, we haven't seen all the M&A we were expecting to see. People have no patience, but it's coming. And I think you need to get the regulatory agencies aligned with the president's agenda. I think it's taken a little while. I'm not sure they all know they all have jobs. So I think that's part of it. But I do expect we're going to see more transactions. What we have seen is transactions have sped up. Approval times have sped up dramatically. I think that's really important. I think the other thing that people are looking at is economic uncertainty, right? What are interest rates doing? What's the Fed going to do? Are we going to have a recession or not? How deep will it be? So financials are always taking it on the chin. They always want to bring it back to 2007 and 8. And, this is not that. The banking industry's done a great job. They've not taken a lot of risks. There's not a lot of crazy products out there like there were in the mortgage world. And I think the consolidation is going to be very impactful. And, by the way, a lot of the really smaller banks trade very close to book value, trade single-digit earnings multiples, and their book value is going to climb a lot this quarter. If you think about what's happened to the bond market, you've seen big gains in the bond market. Banks hold a lot of U.S. Treasuries, so you're going to see a lot of gains there. You're going to see earnings. Book values will be up, capital will be up, which leads to buybacks, leads to more M&A, leads to dividend increases. So I think things look pretty good in terms of, where I expect things to go, especially in the smaller bank space. And, the larger banks will be fine. I think capital markets will be slow this quarter. When you put up a slide like this, you look at the largest banks and capital markets will be quiet, right? We've seen a very volatile market, so very difficult to have IPOs and secondaries and have them perform well. So I think there's a latent desire for M&A to happen, period, and certainly a latent desire to have more capital markets activity. I think once there's clarity, I think you're going to see a lot of activity across the space from small to large.
So are you thinking about how you invest in the regionals that have less capital market exposure differently than those that have more?
For most part, most of the regionals have very little capital markets exposure. First Horizon is one of my bigger positions. They have capital markets exposure, but it's mostly fixed income, and they should actually do pretty well from that perspective.
So I guess what I'm asking is, do you think that, would you stay away from some of the larger banks that do have that capital market exposure, and is that one of the reasons why?
Well, certainly I think you've seen some people take numbers down. I think it started today of the larger banks, but they're all not very expensive. But the bigger the bank, the higher the multiple, the higher price to book, higher price to earnings. And so the real opportunity is to go small, where you get much closer to book value valuations, much lower single digit earnings multiples. Then they don't have that type of exposure. So I do prefer the small, and I do prefer consolidation candidates among that space.
How do you target those consolidation candidates, right? What criteria are you looking for when you're trying to figure out where there might be some combinations?
Sure. I mean, certainly age of management's always been one of them. Inside ownership, you definitely want them to have a lot of skin in the game. And you also want to own companies that are in geographically desirable areas, right? If you're in Florida or Tennessee or Texas, or, certainly in the Southeast, you've got a lot of good growth. So, what I really like is when you have companies that have that optionality, that have really good growth and good earnings prospects, and everybody wants them, right? You win either way. They perform well, you win. They get taken out, you win.
And getting back to the sort of macro environment here, I'm curious how it's affecting, if at all, loan growth at some of these regional banks, right? Because we look at all of the sentiment surveys, one would think that would have an effect on something like loans.
You're absolutely correct. Loan growth is going to be very slow this quarter. And, again, leading to the same thing I said earlier, which is capital is going to build at these banks. So, from talking to all the banks that we talk to, and we talk to hundreds of them, what they all see is clients waiting, right? Waiting for the rules. I know the Fed came out yesterday and said that doesn't matter. It does matter. Anybody who's in any business, importing, manufacturing, you name it, is waiting for the rules. And once they know what the rules are, they can engage. And I expect a much stronger second half of the year in terms of loan growth, as well as the economy.
Anton, thanks so much. Good to see you.
Great pleasure.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks this session with Yahoo Finance's trending tickers page. Joining me now, Catalyst co-host Madison Mills. And Maddie, we're looking at Shake Shack here this morning, Roblox and Goldman Sachs. First up, we got Shake Shack. It's raised to buy from hold at Loop Capital Markets. The firm citing a recent pullback in shares and potential upside from earnings as a reason to buy here. It's interesting because the tenor of the note, even though it's just now upgrading it, sounds like they've been relatively constructive on the company for a while. Maybe they were just waiting for the stock to pull back.
Yeah, and they talk about the 25% decline since the last report that they had in January, calling that a buying opportunity. They talk about how Shake Shack has had better than expected comparable sales growth for 3 consecutive quarters, which they see as bullish. Comp sales growing 3.7% in January, despite poorer weather, which we saw pulling back on some of their competitors in the space here. They talk about also the success of some of their, company fundamentals, things that are specific to Shake Shack, the offering of the black truffle burgers, which made me excited to go try that because I have not, in the KBBQ burger as well, and also continued digital sales growth. So they see that management's guidance for a 3% comp sales growth for this year, they see potential upside in that. And you can see there that the stock is under pressure over the last year, so potentially some upside there according to this note.
Have you had that Korean BBQ burger?
I've only ever had the main burger, which is ridiculous. I haven't even tried the shroom burger.
I have had the shroom burger.
Try.
It's been a minute. It's been a long time since I've had that shroom burger, but it's good.
Quite good.
I've
heard.
Let's move on to Roblox here. It's announcing a new format for video advertising along with a partnership with Google to help boost its ad business. And you know, the challenge, I got some Robloxers in my household, and the challenge is like getting the ads to be a part of the ecosystem that makes sense.
Yeah.
And so it seems like they're trying to get there.
That was a fascinating learning for me as someone who is not a gamer and does not live with gamers, and you already knew that. I really perked up at that takeaway from Scott Scheffer, the VP of sell-side monetization at Google, talking about this. He said gamers are so entrenched in the experience that you can't rely on your laurels when it comes to advertising. You have to kind of have a unique format. So moving forward, gamers are going to be able to choose to watch a video ad up to 30 seconds long in exchange for kind of gaming rewards like lifeline boosts. I'm sure you know the terms better than I do, Julie.
I mean, I'm just a tourist. I don't really know that much. I got secondhand knowledge, but not entirely. But yes, anything that can get them more in Roblox.
Robux, that seems big.
Anything that gets them further along, they will do. There's a lot of AFK training that happens away from keyboard where you like set a thing and it just runs through the,
Can I be away from keyboard? Is that something we can incorporate into day in and day out life? I like that.
I'm not sure it'll work quite as well for our purposes, but but it is, you know, it's important to like rack up the whatever.
Right, exactly,
So
it's critical.
If the ads can help get them there, that might indeed be a helpful thing for the company.
Indeed, that is true.
All right, and finally, big bonuses for Goldman Sachs CEO and president. They're drawing criticism from proxy advisor Institutional Shareholder Services. First, it was Glass Lewis sounding the alarm on this $80 million retention bonus for the CEO and president. Now it's ISS who is also chiming in.
Yeah, the kind of push and pull, which has historically also been a challenge, right? How do you retain top talent while also not leading to any sort of pushback from shareholders or from firms like this about, you know, potentially overpaying and that being a headwind to the company moving forward, especially if these compensation packages are deemed a little bit too excessive. I know that for 2024, we saw Wall Street bonuses hitting a record high in New York. I believe it was somewhere along the lines of $240,000 annually for a record there, and a huge pop from 2023. So it'll be interesting to see where these bonuses go, given that the deal-making environment hasn't necessarily cooked to the degree that was anticipated for this year.
I mean, I will say usually these pay packages do get approved, even sometimes when you have the proxy advisors recommend against them. And in this case, we're talking about David Solomon and John Waldron. Bloomberg's reported that other firms have tried to poach John Waldron, although he's seen as a successor to Solomon. And so the firm said in a statement that, you know, this is about competition for our talent is fierce, and this is about keeping them here. This even as Glass Lewis said that compensation was excessive. And ISS talked about, I guess there's already a pay package in place from 2021 that hasn't run out, and so they said it's not good practice to then introduce another before the last one
Which
has
makes
finished.
sense. That makes sense.
It does make sense.
And is the risk of losing the successor to Solomon enough? I mean, that's also not good for shareholders, potentially, as you point out.
Exactly. Something to consider.
Absolutely.
Thanks, Maddie.
Thank you, Julie. Ton of fun.
Appreciate it.
Yeah.
Coming up, why one economist is still feeling constructive about the U.S. economy. That's next on Wealth. U.S. job openings fell slightly in February to a 4-year low as the labor market shows continued signs of cooling. This morning's release kicks off a week packed with labor market data, culminating with the March employment report on Friday. Joining me now is Stephen Rasciuto, Mizuho America's U.S. chief economist. Steve, it's great to see you. As always, I'm curious what you made of the JOLTS data today, that job openings data. It did show a little bit of softening there. Does it tell us anything about what we could hear Friday? How are you thinking about the labor market?
Well, I think the net of all the data released in the JOLTS report implies to us that we're going to get a healthy gain in payroll employment. It's not going to be substantially stronger or substantially weaker than the last number. There'll be rounding error differences between what happened in the month of February and what happened in the month of March. It tells us that basically the labor market remains firm.
And when we think about this whole debate about hard versus soft data, what we say we're going to do versus what we actually do, we had another entrant in the hard category today besides JOLTS, and that was the ISM manufacturing report, which showed a little contraction last month and also showed an uptick in prices paid. You know, again, we're trying to weigh here all of these elements. How does that strike you in this sort of look for evidence in softening in that hard data?
Well, we tend to look at the ISM number and put it in the soft data category, to be honest with you. It is built on perceptions of purchasing managers. And, you know, when you talk to management, I've never heard a CEO or a treasurer or CFO on any news program say, well, my purchasing manager is telling me this is what's happening in the economy, and therefore we're adjusting our outlook on the economy. I think the reality of the situation is it's an expectational series, and it really doesn't give us as much signal as the hard data. The hard data that came out in the JOLTS numbers this morning show you a labor market that is still fairly firm. We had hirings that were very, very healthy. The quit rate remained at a very, very healthy level. All those factors are telling you that people are still out there. They're still in an environment where they can get jobs. They've got jobs. They're comfortable in their jobs. And I think that's the critical component. You even were talking before about a specific retailer that was noticing 3 particular quarters of upbeat news in terms of their sales growth. I mean, I think this is all part and parcel of the reality that, yeah, if I'm sitting there saying, well, you know, maybe I'm not going to go out and do that very, very large purchase, that doesn't mean I don't go out and do a number of smaller purchases and keep the economy moving at a healthy clip.
So, Steve, as you point out in your most recent note, you guys are still relatively optimistic about where the economy is going this year. You're looking at 2.3% GDP growth by the fourth quarter, which is above consensus here. And you talk a little bit in the note about what you're seeing that you think other economists might be missing here. What do you think are some of those key things?
You know, I think a lot of economists pay very, very close attention only to the data and monetary and fiscal policy. When in reality, you have to understand we are the largest, most leveraged nation in the world. Unless you understand the flow of liquidity within the economy, you're missing an important variable. And this goes back to looking at 2023, for example. You had somebody else on your show earlier talking about the rebound in regional banks. In 2023, regional banks got hit pretty badly. They've been recovering nicely, as your earlier guest indicated. But everyone projected a recession based on the damage done to regional banks, forgetting the fact that the liquidity that pulled away from liquidity from regional banks had to go someplace else. And where did it go? It went into other components of the economy, and the economy actually accelerated in 2023. So we put a credit overlay on top of our traditional macro models. We look at balance sheets. We look at the health of balance sheets, household sector, corporate sector, banking sector, shadow banking industry. And then we look at a systemic risk model that we have. And we see that those balance sheets are very healthy and there is no systemic risk in the economy. So if we see an economy that loses some spending in consumer goods, we're likely to see an economy which can actually pick up spending into consumer services. And we only get one real piece of data out on that. That's hard. That's in the personal income and spending report. We get out the weaker ISM service number, the softer numbers there between hard and soft data. And last time through that, you know, ISM for services was fairly healthy.
So when you talk about all this liquidity, put another way, you think there's basically enough cash sloshing around the system to ride out maybe, you know, a little bit of softness in sort of spending intentions, that people have the money and so they're going to spend the money?
It's not just the liquidity sloshing around the system. It's the fact that credit is available. People who want credit can get credit. Corporations that want to raise debt are raising debt at very tight spreads. Individuals can get a mortgage if they qualify for it. No one's sitting there saying, you know, I'm not going to lend to anybody. That's a credit crunch. We're not in that environment. So uncertainty could push us from above trend growth for a quarter or so to below trend growth for a quarter or so, but it's not going to produce the recession stories that are propagating out there in the market and dominating the consensus forecast that has GDP below trend every quarter this year. which makes absolutely no sense in an environment where the Fed is telling you, we're here ready to cut rates if we feel we need to. We don't think we need to, but the market's discounting 3 rate cuts. And you've got the potential for more fiscal policy stimulus coming this year on the backdrop of fairly aggressive stimulus by Joe Biden on his way out the door in December.
Steve, a little optimism here. Thank you so much. Good to talk to you.
Cheers.
Coming up, a slew of new inventory is hitting the housing market, but that may not necessarily be a good thing in the longer term. We'll discuss why next. Home builders are currently sitting on the most completed unsold inventory since 2009, according to the Census Bureau and HUD. I spoke to the CEO of Rocket Companies, which announced its acquisition of America's largest mortgage servicer, Mr. Cooper, for $9.4 billion. Here's what CEO Varun Krishna had to say about housing inventory levels.
We see some really positive green shoots. We see inventory up. We see more homes selling at or below list. We don't see as many of those competitive bidding dynamics that have existed in the past.
Here to talk about what this means for the market is senior housing reporter Claire Boston. So, Claire, in theory, it seems like the housing inventory rising would be good news for buyers. They would have more choice. Is that how it sort of plays out?
You know, that is sort of what happens. So especially on the new home side right now, we have about 119,000 new homes that are completed, but they are waiting for buyers. And builders are very excited to get these off of their books, and that can result in really good deals for those buyers. For example, builders are often willing to buy down a mortgage rate, give people closing cost credits, and kind of other things like upgrades as well. But the flip side of this is when builders have a lot of houses that they're sitting on, that means they're probably not rushing to build more houses. And so in the longer term, we still have this really big housing shortage in this country. Mm-hmm. And so if builders are not able to sell what they have, they're not going to rush out to kind of help dig us out of that hole any further.
That makes sense, especially at a time when their costs are going up because of tariffs, labor's not exactly going down. So how does this kind of balance out between new home inventory and existing home inventory? What do those two pictures look like?
Yeah, so on the existing home side, we are seeing better inventory as well, but it is not nearly as intense as on the new home side. New homes, they're at the highest level since 2009, and existing homes in a lot of market inventory is up, but it's still not back to that kind of pre-COVID dynamic. A lot of people I talk to, especially in the agent world, they have customers that maybe are considering a new or an existing home, and a lot of them end up going that new home route because of those discounts. They're just better right now.
That's interesting. I will say anecdotally, in my town in New Jersey, I have been seeing like the spring selling season seems a little more active than it has as of late. Are we seeing any regional trends that are telling us what's going on with inventory?
Definitely. We have a really bifurcated market right now. Competition is intense, especially on the coast. So New Jersey, there is not a ton of inventory, although we are seeing that seasonal rise. But then if you're going to go somewhere like Texas or Florida, they have some of the highest inventory levels ever. And so a lot of this is about where builders are able to build. It's a lot easier to build in the South. There's more space. The zoning is less restrictive. But people are kind of moving around. RTO is sort of changing the game. Maybe some people who tried out Florida living during the pandemic are now thinking they want to try something new. And so how good your deal is going to be will depend a lot on where you live.
Yeah, makes sense. Claire, thanks so much. Appreciate it. Well, the dynamics in the housing market have shifted once again, with baby boomers regaining the top spot as the largest share of home buyers in the U.S., overtaking millennials, who fell by nearly 10% from the year prior. This is all according to latest data from the National Association of Realtors. And joining us now on this is Jessica Lautz. She's the Deputy Chief Economist and Vice President of Research at the National Association of Realtors. Jessica, it's good to see you. So this is really interesting here. That baby boomers retook that top spot. What drove that change?
Well, it really has to do with housing equity. Baby boomers are really the winners in today's housing market. When we talk about that bifurcated housing market, we can see young millennials struggling to get in, really wanting to become first-time home buyers, but baby boomers have housing equity and they're making their moves in retirement.
And I guess because of that housing equity, we're seeing more cash buyers as well. I guess if if you've got that equity that you've built up in your baby boomer and you sell your house, then you have, I guess, that liquidity to use to buy another one.
Yeah, certainly. We're really seeing stacks of cash in the housing market right now. When we look at older boomers, we actually know about half of them are purchasing their home with all cash. So someone in their 70s. If we look at someone who's in their 60s, so a younger boomer entering into retirement or perhaps close there too, we can see it's about 40% of folks who are purchasing their home with all cash. And if they're not making an all cash purchase, they're making a home purchase with a very large down payment. So it's really offsetting a lot of the costs. They're able to purchase exactly what they want to do in that perfect neighborhood that they want to be in.
So that's really interesting, because when you look at the older generation overtaking, once again, the younger generation, you would think affordability would be a factor. But it sounds like what you're saying is it's also that cash and down payment percentage is a factor, because I imagine younger buyers are less likely to have that ability to give that larger down payment.
Oh, certainly. I mean, when we look at younger buyers, they're going to be financing their home purchase largely. Now, I want to say one thing here is that millennials are the biggest generation in the US today. So when we see them left out of the housing market, it doesn't make a ton of sense. But what we can see is that when we divide up the millennial generation, just knowing how big it is, we actually see that older millennial buyers are more likely to be repeat buyers in the market. So they're earning that housing equity too. They're not at the point where they can make an all cash purchase, but they do have that in tow when they make their next purchase.
One of the other trends you all notice is the rise of multi-generational homes, right? Mm-hmm. I'm a sandwich generation person, so I get it, right? People buying homes where maybe their parents are living with them. How widespread is that trend? What can you tell us about it?
Oh, it's extraordinary. When we look at Gen Xers, it's about 20% of them are actually purchasing a multi-generational home to take care of aging parents, to take care of kids over the age of 18 who boomeranged back, kids under the age of 18. So everyone within this household, that's a lot of financial pressure on that Gen X buyer. And we know that they have to have a higher income to be able to support everyone, perhaps other folks actually adding into expenses in that household as well, hopefully. But we also know they need a larger home to accommodate everyone.
And one of the other trends that intrigued me is when we're talking about single buyers, that young women are a growing percentage of those buyers. What's behind that trend?
Yeah, absolutely. So we have a drop in marriage rates overall in this country, but single women are really outperforming both in the young and the older spectrum. So we certainly see that women perhaps coming from a marriage or a divorce, perhaps they're widowed, are actively buying in the real estate market as a baby boomer, even in the silent generation. For young buyers, though, we really see that there's a lot of Gen Zers who are single and they're coming into the market. They're not yet married or coupled up. And so they really want to take advantage of homeownership and really buying trends out there.
Really interesting stuff, Jessica. Thank you so much.
Thank you.
Americans must bring in a household income of over $100,000 annually to afford a typical median-priced home in the U.S. That's according to Bankrate. And this figure has increased by 50% since 2020. Bankrate saying that, quote, numbers show the dramatic rise in home prices and the tightening affordability squeeze facing first-time buyers. Bankrate analyzed home sales prices to calculate monthly mortgage payments to determine how much Americans need to earn on average to afford a typical home. In 2025, residents in 8 states and the District of Columbia actually needed a household income of $150,000 or more, with 3 places actually needing at least $200,000. The 3 places where you need that highest annual household income to afford a home: California, Hawaii, and the District of Columbia. The nation's capital requires the highest household income level at just over $240,000. The 3 states with the lowest annual household income needed: Ohio, Iowa, and West Virginia. We're seeing fast growth in household income needed in some western states: Utah, Montana, and Wyoming. Bankrate says, quote, these numbers really underscore the wide gaps in housing affordability throughout the country. And, quote, if you're not ready to buy, there is no shame in renting, or maybe looking in Ohio or Iowa. Coming up, we're continuing our guide to student loans with a breakdown of how to choose the right offer. All week long on Wealth, we're covering the student loan application, acceptance, and repayment process. According to the Common App, which processes applications for over 1,000 colleges and universities, the number of college applications increased about 6% from the same time a year ago. The number of total first-time applicants ticked up by about 4% for a total of about 1.4 million. And those students will soon be receiving acceptance letters and their financial aid offers. Here to help break down what they need to know is Jack Wang, Innovative Wealth Advisory Group College Planning Strategist and Wealth Advisors. So when those acceptances start rolling in, how can parents and students figure out how much each offer is worth, Jack, and weigh them on a relative basis?
Each offer, parents need to really look at the numbers closely. It can be very confusing, especially because sometimes schools only put on what are called direct costs, which are things like tuition fees, housing, and food. But other schools will include those direct costs as well as indirect costs, such as like books, miscellaneous transportation. And so you want to make sure you're doing an apples-to-apples comparison, because sometimes those costs can vary significantly by thousands of dollars.
So there's the types of costs that people need to think about, and there's also the types of loans that students might be offered. You have federal subsidized loans, you have federal unsubsidized loans, and then Parent Plus loans. So talk to us about the biggest differences between those.
Yep. So the federal subsidized loans or sub loans, and federal unsubsidized loans or unsub loans, those are to the student themselves, right? So the parents do not have to co-sign for those. Those are just to the student. And the differences between those two loans are just that the unsubsidized loans accrue interest while the student's in school, whereas the subsidized loans, the interest is waived. So effectively, it's a 0% loan while the student's in school. And so if you qualify for that, that's the best one to get. Obviously that's the best one to get because it's basically 0%. On the other hand, Parent Plus loans are always unsubsidized, meaning that they do accrue interest while the student's in school. But the Parent Plus loans are to the parent, right? And this is one of the most important points I want to emphasize, is that the parent is the borrower, not the student. And so for some reason, the parents are trying to make the student pay. The student's actually not legally obligated to pay on a Parent Plus loan because they are to the parent, not to the student.
That is very important to know for sure, as someone whose kids are going to be heading to school in the next few years. What about the difference between private and public loans, Jack?
So what I like to say is private loans are through various banks, credit unions, different national lenders, and there's plenty of them around. But private loans offer a lot of options up front, whereas federal loans provide all the options on the back end. So for private student loans, the difference is people can choose who the borrower is. For example, it could be the parents, or it could be the student with the parents co-signing. They have their choice in terms of interest rate, fixed or variable. They have their choice of repayment options. For example, you can do interest, no payments during school, interest only, or fixed payments, full payments, I should say, during school. But they carry fewer the legal protections. So there are no income-driven repayment plans and no forgiveness programs. Now, on the other hand, federal loans, everybody gets the same terms up front, right? No matter how good or bad your credit is, everybody gets the same terms. But you have all of the things that have been in the news recently, which are all the different types of income-driven repayment plans and forgiveness programs and stuff that you may be eligible for. And so really the difference between two loans is, do you want your choices on the front end or do you want your choices on the back end?
Gotcha. Lots of different choices, period. And once people weigh all of this, before they decide whether or not to accept the loans, are there any ways to appeal for more or different aid if they don't necessarily like the selections they have?
Yeah, absolutely. So parents and families can always appeal for more aid. The worst thing a school can do is just simply say, no, we're not giving you more money. But you have to be sure in terms of why you're asking, right? Is it because you're asking due to a significant financial change, like, you lost your job or something like that, right? Those tend to go to the financial aid department. On the other hand, if you're asking for what I call the just because, like I just would like some more money to make this more affordable, those tend to go to the admissions group in most schools, right? Not always, but you want to be sure about why you're asking and really have a good rationale. And if it's because of a significant financial change, then obviously you're going to have to provide documentation. And the other point on this is it has to be something that has already happened. So, for example, if someone got notice that they're going to be laid off 6 months from now, that's not sufficient reason versus someone who has already been laid off, where that obviously would be more of a basis for the appeal.
Jack, really helpful information. Thank you so much.
Thanks for having me on. Appreciate it.
A programming note, in this week's episode of Decoding Retirement, host Bob Powell speaks with Christine Benz, Director of Mutual Fund Analysis at Morningstar, about thinking of retirement in phases.
We probably should try to envision retirement as a series of phases. I think it's sort of the human condition that we tend to think that the body that we're in today, the mind we're in today, it will ever be thus. And unfortunately, it will not be as we age. So if we can try to get our arms around, well, what do we want as we age and need to make some of these changes in our lifestyle? If we can get ahead of some of that decision making, that helps ensure that any decisions that, say, children would ultimately need to make on our behalf, that we're doing it ourselves, that we're in the driver's seat. And I think that's terrific advice as well.
You can catch episodes of Decoding Retirement Tuesdays at noon Eastern on Yahoo Finance or wherever you get your podcasts. The Department of Justice plans to seek the death penalty in the case against Luigi Mangione for the killing of United Healthcare CEO Brian Thompson. Attorney General Pam Bondi saying in a statement, quote, "After careful consideration, I have directed federal prosecutors to seek the death penalty in this case as we carry out President Trump's agenda to stop violent crime and make America safe again." The 26-year-old Mangione is being held at the Metropolitan Detention Center in Brooklyn, where he will remain until his trial begins. He has pleaded not guilty to state charges, but has yet to enter a plea for the federal murder charges. Mangione's next federal court hearing is scheduled for April 18th, followed by a state hearing in June. According to the U.S. Bureau of Labor Statistics, 20% of all small businesses fail in the first year, nearly half fail in their first 5 years, and 65% fail in their first 10 years. So clearly it is not easy to start a small business. And it's also not easy to keep one going in the long term. My next guest has beaten the odds, starting a business in 2014 that now has revenue of more than $40 million a year. Here with more is Morgan DeBon, CEO of Blavity. It's a media and technology company with content tailored to Black millennials. And by the way, she's also launching her debut book, Rewrite Your Rules. That's out today. Morgan, thank you so much for being here.
Julie, thanks for having me.
So first, I want to dive into your career and how you achieved that staying power for your business, right? You left Silicon Valley nearly a decade ago to launch Blavity. Launching a business, obviously, isn't always an easy thing. And as we've talked about, keeping it going is not always an easy thing. So what lessons did you learn? What would you advise people who are looking to embark on this path?
You know, entrepreneurship is really hard. You saw those stats. It's rough out here. One of the first things that I did that was really helpful was having really good advisors. Most people get mentors. You know, mentors are people who are with you through the ups and the downs, but an advisor is someone who is really has the skills to actually get you to the next level. A lot of people just spend too much time with people who are emotionally invested in them, but don't actually have the skill set to give them the tactical advice that they need to get to the next level.
Interesting, and that, you know, staying power can be helpful too if that person is sticking with you. So some of the lessons that you talk about here: leveraging your passion, embracing failure, building a solid team, and becoming a master delegator. I want to linger on failure for a moment because, you know, I know that this is really embraced by successful entrepreneurs, is not being afraid to make mistakes and fail, right? So how does that play out in the business? Like, how do you get over that fear of failing and sort of allow yourself to do it?
Yeah, part of rewriting your rules is actually failing quickly. So it's not that you don't fail at all, but the most successful people fail at a really quick pace. They take the learnings, the information, all the data that they've collected through that process, and then they just iterate slightly to get to the next level. And I think that a lot of us, we were conditioned growing up to say, like, I've got to get the A, I've got to get the A. And so we're so focused on perfection, when in reality, we need to be focused on actually getting the information that we need to say, am I validating this idea in the marketplace? Do my customers like this? Are they sharing it? Do I have that word of mouth? That's what's going to help you grow and scale much faster.
What about leveraging your passion? What does that mean when it comes to starting a business?
So starting a business is so hard. There's going to be years where you don't make any money. You might have years where you have almost no take-home pay. So you have to be intrinsically motivated. So you have to make sure that the person that you're solving a problem for is someone that you feel like a lot of joy and passion for. Because at the end of the day, business is going to go up and down. But what's always going to be true is that you're solving a problem for a customer.
And the delegator thing is really interesting to me too, because especially if you're someone starting a business, I imagine for a lot of people it's really hard to trust people and give them things to do. You want to do everything yourself.
That's right. The most successful companies have amazing teams around them, and I saw that working in Silicon Valley. One of the things that more people have to get comfortable with is if someone can do it 80% as good as you should let them do it. They're never going to be 100%, like ever, right? So, but it's important that you build a team around you that can offset your own skills, which will help you get to the next level. And look, when you're starting off, you may have no cash. You may say, well, how am I going to pay for these people? Well, you have skills, so maybe you can barter and trade. When I was first starting my company, I needed someone to help me hire people. I wasn't a recruiter. I wasn't good at hiring. I didn't know what to look for, how to write a job description. But my girlfriend, Jackie, wanted to be a recruiter. So she was like, I'll take the experience. I'll help you hire your first few employees. In exchange, you're going to be my reference when I'm trying to make this career switch. And now Jackie's an incredible tech recruiter for some of the best companies in the world 10 years later. And some of those first employees are still at Blavity today.
It helps to know Jackie's, I guess. Let's talk about investing too, because what is your mindset around growing your money through investing, and how do you talk to people about their finances?
Yeah, most people in this country are taught that saving is the goal. That's wrong. The goal is investing. That's how you're going to actually get ahead and have that generational wealth that we talk about so often. Saving is just going to be accumulating money in your bank account. But what you really need is a return on those savings, even if it's something as simple as a high yield savings account. It doesn't have to be complicated. You don't need to trade stocks and do all of this crazy stuff for Bitcoin. Just start with the basics, high yield savings account, making sure if your company offers 401k matching, are you actually taking advantage of that? That's free money. Are you investing that money you're putting in that 401k? So just making sure that you're doing the basics of personal finance, that goes a very long way.
And what about at a time like this, where the markets are pretty volatile, it's an uncertain environment? You know, obviously, if you're doing a high yield savings account in this environment, that's all good. But if you're trying to actually invest in the market, it can be tricky.
This is the best time to invest in the market. This is actually where people make a ton of money, because the value of a lot of companies, they haven't changed even though their stock is down, right? Companies like Microsoft or Nvidia, these are fantastic companies. They're the same product they were today as they were 6 months ago. Now you're just getting a 30% discount. So your money is going to go much further in today's market.
Okay, thanks so much.
Thanks for
coming in. Appreciate it.
Yeah.
It's time now for Tech Support, our weekly look at the latest news in all things technology. And if your social media feeds have been overrun with recommendations for low-quality AI-generated content, there is a way to spring clean your algorithm. Yahoo Finance's Dan Halley has the answer for us. So how do people clean up their feeds from this stuff?
Yeah, Julie, this is what's commonly referred to as AI slop. And it's basically just AI trash that, litters your feed. We had a few examples there. One, there's a cat that was dressed as Trump at a McDonald's. There was this one of there's this weird trend of sea creatures being cleaned of barnacles that seem to be real, but it's not. Yeah, it's bizarre. But there are ways to get rid of these from flooding your feeds. Look at that fluffy orange cat. Not real, by the way. If you're on Instagram, no, it's shocking. That's the sea life one.
That looks a little more real.
Yeah.
Yes, although I don't know how all those barnacles would grow in a dolphin, but anyway.
Yeah, it doesn't make sense. To get rid of these on Instagram, what you're going to have to do is you're going to have to go tap your profile icon in the bottom right corner of the screen, and then from there, you're going to hit the 3 horizontal lines, that hamburger menu at the top of the screen, and then you'll want to select content preferences. Now, from here, you're able to do everything like change what you're interested in or not interested in, which words or phrases you want hidden, but you'll want to go ahead and tap Reset Suggested Content. Then you get to a screen explaining what that does exactly. You'll be able to change the images, videos that you see normally, and then that resetting this content can't be undone. So you'll want to go ahead and tap Next. You'll get a pop-up asking if there's anyone that you want to unfollow, any accounts you don't want to see around, and then press Reset Suggested Content again. From there, you're all set. That'll get rid of those on Instagram on your Explore page. Now, That doesn't mean that you're not going to see them anymore, but you'll still have them around occasionally.
Got
They're
it,
not gonna
but
flood your feed.
less so, hopefully. What about TikTok?
Well, TikTok is similar. You also have that ability. What you're going to do is, again, go into your profile, and you're going to tap another hamburger button. This time it's going to be in the top right again, and then select Settings and Privacy. From there, you're going to go to underneath Content and Display. There's Content Preferences, and then you're going to tap Refresh your For You feed. And this will provide you with a page explaining how this works again, and that it won't impact videos that you see from accounts you follow. So your friends and stuff like that, or accounts that you actually want to see, it's not going to change that. You're going to press Continue at the bottom of the screen, and then refresh. You'll get another pop-up, and then boom, hit that button and you'll be done with these ridiculous AI things for now. They're not going to fully disappear. This is just stuff that's flooding the internet. Everybody sees it now. But if you've clicked on it once, this is what happened. I saw the dolphin thing and I was like, man, is that real? There's no way that dude's touching that dolphin that close. And also the barnacles thing. Tapped it and then boom, my feed was just full of weird shapes, like coming off of like trees and stuff. Yeah, it was really trippy. And so I was like, I got to get rid of this nonsense. I hate this. So just cleaned it up and now it's back to, video games and all sorts of nonsense like that.
And real cats.
Yes, real cats. The things that matter the most. Real cats.
Exactly. Thanks, Dan. Appreciate it. Well, let's do a final check of the markets right now because we have been seeing things go more positive. We got the NASDAQ. It was leading to the downside. Now it's leading to the upside, up 0.8%. That's it for Wealth. I'm Julie Hyman. Thanks for watching. And stay tuned for Market Domination. That comes up at 3 p.m. Eastern.